Thank you all very much. I'm very pleased to be back here today and provide an update on the progress that we've made over the last 12 months, and more importantly, what we want to do and what we want to achieve over the next 12 months. I note that we're making forward-looking statements. You'll be able to find this presentation on our website, so please go there and read in some detail. I've got a new slide for today that I think really speaks to our specific example, but more broadly to the power of the free cash flow being generated by gold producers. This chart shows in blue the cost of producing an ounce of gold from our La Colorada mine in its history since it was restarted in 2014. And then in green is the margin, the profit per ounce that you see there. And it's incredible to see that margin expansion in the last couple of years. It's been very consistently around 200 to 400, which has been the long-term average as long as I've known. And then recently, in the last couple of years, you're seeing this significant increase in the gold price, which leads me to ask the question that, is now the best time in history to be buying gold producers? And if I wanted to push Heliostar's case, if you believe that, well, a growing producer is an even better asset to buy in this environment. Our aim, as it's always been, is to be a mid-tier producer doing 500,000 ounces a year at the end of this decade. We've made some significant progress recently, but I think there's another part that I think is really important to us, is we also want to do it growing our share price. And so everything that we're doing is trying to generate our growth from our cash flow so that we see the growth in the company reflected in growth in our share price. We've got an extremely strong portfolio to build that from. We've got our two operating mines, La Colorada and San Agustin. We've got our development projects, initially Ana Paula and then Serra de Gaia to follow. The turnaround of these assets has been quite significant over the last 12 months, from the attention and focus that they'd been missing previously, combined with obviously an incredible tailwind with the gold price. We restarted La Colorada and now have a 6.5-year mine life, all in the last 6 months. We're going to restart San Agustin, having received all the permissions and internal approvals to restart San Agustin in Durango, and then I'll provide an update on our progress, both drilling and in the feasibility study for Ana Paula. And so for those who don't know the assets closely, our operating assets in Sonora and Durango are key development projects in Guanajuato and Guerrero. We have 3.2 million ounces in M&I resources, and once we update the study on Serra de Gaia shortly, hopefully double that to close to 6 million ounces on the back of updating the technical report. The only reason it wasn't updated was we had so much work when we took on the acquisition of the assets that we just deferred that from a management bandwidth perspective. This chart speaks to what we think we can grow to as a company. What you can see in blue and green is the production profile from San Agustin and La Colorada, supported by the technical studies we have out publicly. And then in the dashed lines is what we believe is management that we can bring online and the timing that we would like to organise those. I note that they are not final decisions. They need potentially investment, potentially permits, potentially additional studies, but they show how we want to grow this business. We think we can expand our production profile next year, and then we think we have a big step change in 2028 when Ana Paula comes online, and then ultimately we think we have an organic pathway to over 300,000 ounces from the assets that we own 100% by 2030. That gets us a significant way to our corporate goal, and I think if you want our business proposition in a nutshell, if you look at 150 to 200,000 ounce a year producers right now, they're trading at sort of multi-billion dollar market caps. We're at about a 400 million Canadian market cap today. We think we can get to that scenario with very little to no equity dilution, combination of cash flow from our assets and project financing for Ana Paula. So if we can get to those valuations without issuing any more shares, that's significantly multiples on our share price. And I hope what maybe differentiates us ourselves is you've got some of the same exploration some of the same upside potential as developers and explorers, but you've got the backstop of our production profile and our cash generation that changes the risk profile of us relative to some other investments. I touched on that around 400 million market cap. We have 30 million cash in the bank. Most of that has come from free cash flow generation over the last 3 quarters. We have no debt. We have just under 10 million of warrants that are materially in the money, owned by our biggest shareholders, Eric Sprott, Franklin Templeton, Adrian Day's Europac fund. That'll come in over the coming months and until October next year. And we're starting to grow both in institutional ownership and coverage from larger firms and funds as we grow in company size and as people see that we're starting to deliver on our plan to build into a mid-tier. Our management team has worked in Mexico, has built mines in Mexico, has operated assets across multiple jurisdictions, comes from backgrounds including Newcrest, Newmont, First Majestic, Stiefel, a well-rounded team. We're doing it for the first time in Heliostar, but we're very comfortable with the team that we have in place. I think you're seeing that in the turnaround of the assets since we've acquired them, and we look to further frank that with the building of Ana Paula. Our guidance for this year is 30 to 40,000 ounces of gold at around a $2,000 AISC. We're on track for sort of the bottom to middle end of our production range, and as we saw from Q2, we're materially below on our cost guidance. I think we might have been just a touch too conservative on our cost guidance. By taking on new assets, we didn't want to take sort of unnecessary risk there. So I think we're tracking at the bottom end of our cost guidance range for the year. In Q2, our cash costs were just over $1,400 per gold equivalent ounce and just over $1,540 for AISC. These are high margin assets that we're producing from. That's below the sort of $1,700 to $1,800 range that we'd forecast. A part of that is additional production. Some of that is also actually beating our budget metrics for the year. We will model a higher cost to restart San Agustin in Q4, and then that should return back to a sort of $1,700-$1,800 life of mine AISC cost going forward. So really high margin assets for Q1, 2 and 3 this year. Expect a higher AISC cost as we restart San Agustin in Q4, returning to low costs in 2026. We generated $14 million in cash flow from the assets. We've got over $50 million in working capital with the no debt, as I said before. We've got a really strong balance sheet and we're funding our production growth internally. To talk to each of the assets just a little bit and give an additional colour, I'll start with our La Colorada mine, where even we've been surprised by the opportunities that it's afforded us. Originally, when we bought the project, we anticipated that we'd have to cut back that Creston pit in the middle. We were thinking we would need $50 to $100 million to do that. And that was done because the previous operator stopped doing the sustaining stripping. They were trying to maximise cash flow as they got into some financial difficulties. The opportunities for us have come twofold. The first is recognising these waste dumps that were put there as waste dumps are actually very profitable stockpiles today. This year we're mining from the junkyard stockpile. We've just completed drilling today at El Dorado and we'll have results that we believe will drive production next year from El Dorado. As an interesting quirk, when El Dorado mined the Gran Central pit, the junkyard was the waste. We're going to make more money per ounce off the waste than they made off the actual ore in the 90s. That's how much the gold price has changed in the last 30 years. We're about to put out a technical study that shows what we believe will be improved economics on the 6.5-year mine life with the Veta Madre pit and then Creston. And what you can see in the labels is the timing that we expect to mine these different areas. We think we can generate enough free cash flow, if not all very close to the free cash flow from the stockpiles, that'll allow us to do the Veta Madre cutback. And then once we do that, the cash can either go to Ana Paula or it can go to the Creston expansion, depending on market conditions in a couple of years to make that decision. For us to have gone from acquiring it to restarting it to a 6.5-year mine life, and now we believe legitimately having a pathway to fund all this organically has been an incredible transformation. We think we'll average about 50,000 ounces of gold a year out of La Colorada for the next 6.5 years. I'll jump ahead and talk about where we think that might be able to grow. We think at the Veta Madre pit, there's a target area with just under 30,000 ounces that we pulled out of the last tech report. We just didn't have enough drilling in it. We think if we put a couple of more holes in there, we might be able to add another 6 or 12 months worth of production out of the Veta Madre pit. That's a significant amount of cash flow for us that we can put on the balance sheet to help build Ana Paula. At the Creston pit, we've drilled some really nice underground mine potential, some grades and widths that have the potential to be underground mineable. 5 to 10 metres at 5 to 25 grams per tonne gold. And then if you step out more broadly, this is a package that's seen very little exploration. We're going to drill 20,000 metres since acquisition to the end of this year. That's more than it's seen in like 5 to 7 years before we acquired the project. We think there's some really good targets. That soils target is 2 kilometres along, above the cut-off grade of the current reserves, and it's never been drilled. That's the prospectivity we see at La Colorada, and we think that we can grow the mine life well beyond the 6.5 that we already have in the tech report. And now that we've bedded down the production certainty and sort of simplified the plan for La Colorada, we can really pivot to look to growth over Q4 and into next year. At San Augustine, jump ahead to this slide here, we received all the permissions, permits and internal approvals to expand the pit at San Augustine. We're doing the work at the moment. We anticipate we'll be starting to stack new material in October, and we'll start to see gold production out of the corner area in Q4. That gives us, at $3,000 gold, another $40 million in cash flow. We think between San Augustine and La Colorada, with significant spends on our projects, still 100 to 150 million in free cash flow over the next 2 years from these assets. That's the cash flow that we're going to use with project financing to build Ana Paula. Further, it's also giving us the confidence now to look to expand San Augustine. We're going to drill and look for additional oxide resources. We're going to drill another 10 to 15,000 metres late this year, early next year at San Augustine. As a company, we're going to drill more metres this year than we've drilled in our entire history. And more importantly, we're going to fund it out of the cash flow of our operations. All of this is leading us to what we believe is a step forward in sort of quality and scale of our assets. And that's the Ana Paula project. Right now, Ana Paula has 700,000 ounces M&I at 6.6 grams, another 450 at 4.2. The only reason the inferred ounces are so high is we didn't have the balance sheet in 2023 into early 2024 to drill that off and convert it. Right now, we're drilling a 15,000 metre program. We're likely to add an additional drill rig to speed that up. We put out some results, between 15 and 30 metres at 5 to 13 grams per tonne gold. What separates Ana Paula in our mind is the widths and the grade. This is a 60 metre wide ore body, averaging over 5 grams per tonne. We're aiming for a 10-year, 100,000 ounce a year mine life in the feasibility study. We think we can get that with the current reserve program. We're in the process of the feasibility study. We've completed the flow sheet. We're moving towards designing the tailings design. That'll inform the permit modification from open pit to underground, and we'll be working through next year to complete that. I note that when the cash flow starts coming from San Augustine, we intend to expand that decline and complete the decline next year as well. Behind that, we have the Cerro de Gaia report coming out, so I think I'll close focusing on what I think our news flow is, and I think what drives the valuation of Heliostar over the next 6 to 12 months. I've left this up since the acquisition because I want to show that we've just been steadily ticking off the things that we needed to do to show certainty in our production profile and then start to show, NAV growth, the true value of the assets that we own. And so I like to think of our news flow on 3 levels. The base level is our quarterly production figures showing the free cash flow generation of the assets, demonstrating that we have a viable, profitable business with our existing assets. Then above that, I think we have 3 big deliverables. In September, we'll deliver the updated technical study for La Colorada. In Q4, we'll do the PFS for Cerro de Gaia, and I think we're getting zero value for Cerro de Gaia. I think if that was a standalone company, it would carry a significant valuation. And then the Ana Paula FS behind that. And then lastly, as I touched on, 20,000 metres at La Colorada, 10 to 15,000 metres at San Augustine, 15,000 metres plus at Ana Paula. There's a lot of resource growth upside. There's a lot of exploration potential in the assets. We're focused on delivering 150 to 200,000 ounce production starting in 2028. We want to do that with very little equity dilution. And if we do that, we think we're worth multiples of where we are today. Thank you.
Thank you very much.